The silence is officially over. On January 13th, 2026, federal regulators walked into a Chicago bank branch, locked the doors, and seized every single penny in assets. The narrative that the banking crisis was contained, dead on arrival. This wasn't just a random closure. It was the first domino of 2026, and it proves that the financial lag effect we've been warned about isn't coming. It is already here, and it is violent. For months, the financial world has been gaslighting us. They lulled the markets into a sleepwalk. They told us the system was stable. They told us the fires of 2023 and 2024 were extinguished. But that was a lie. Think of the banking sector like a house. For the last 6 months, the fire alarm stopped ringing. We thought the fire was out. But in reality, the fire was just moving inside the walls where you couldn't see it. Now the smoke is pouring out. The sudden failure of Metropolitan Capital Bank and Trust proves that the distress didn't vanish. It just went underground. And now it is breaking through the surface. If you have money in a bank right now, you are playing a dangerous game without a rulebook. You need to know which domino falls next. That is what I do here. I track the failures so you don't become a victim. Hit that subscribe button right now. Do not wait until the news is on your front porch. I read every single comment to see how real people are feeling about this economy, so let me know below. Do you trust your local branch? Also, a quick nod to my partner channel, Finance Unfold. Go give them a follow as we build an army of informed savers. Now look at the specifics of this collapse. The failure of Metropolitan Capital is a warning shot. At the time of closing, the bank held about $261 million in assets. Now, you might look at that number and shrug. Compared to the giants like Silicon Valley Bank or Chase, that is a drop in the bucket. It wasn't a massive, system-wide monster, but do not let the size fool you. This is not about the size of the boat, it is about the hole in the hull. This failure is a check engine light for the entire U.S. economy. It signals that the pressure on smaller community banks, the banks on your street corner, has reached a breaking point. Here is exactly what went down. The Federal Deposit Insurance Corporation, or FDIC, stepped in as the receiver. Basically, the government fired the management and took the keys. To stop a panic, they immediately struck a deal with First Independence Bank out of Detroit. They executed a purchase and assumption agreement. This is standard procedure to keep the peace. It means that overnight, every account at Metropolitan was moved to a new owner. If you were a depositor, you woke up Monday morning and your debit card still worked, the branches reopened under a new name. Your money was safe, backed by the federal government, but if you owned stock in the bank, or if you lent the bank money as an unsecured creditor, you got wiped out. Zero. That equity evaporated the moment the regulators signed the paper on Friday. The official report blames unsafe and unsound conditions. That is regulator speak for they ran out of money. They cited an impaired capital position. But let's translate that into plain English. The bank was crushed by the economy. Metropolitan was a commercial bank. They served small and medium businesses in Illinois. These are the exact types of borrowers getting hammered by inflation right now. Think of it like a vice. On one side, the bank holds old loans that pay them pennies. On the other side, they have to pay depositors, people like you, high interest to keep them from leaving. The vice closed tight, margins collapsed, and the bank popped. When business borrowers stop paying loans, the bank takes a direct hit to its savings account. When that account drops too low, the state shuts them down. This breaks a deceptive quiet streak. We saw no failures in the second half of 2025. The last one was Santa Ana National back in June. Before that, Pulaski Savings in January 2025. Notice the pattern? January 2025, January 2026. It is starting to look like the new year brings a hangover for the banking system. Pulaski failed exactly 1 year prior to this current disaster. This suggests we are looking at a trend, not a coincidence. There is a localized infection in the Illinois banking market. But do not make the mistake of thinking this is just a Chicago problem. That would be dangerous. The same poison that killed Metropolitan Capital is flowing through the veins of thousands of banks across America right now. They are all fighting the same math, and the math is losing. Metropolitan Capital was bleeding out, slowly, painfully. It was a classic death spiral. They were stuck holding old cheap loans. Those loans paid them pennies. But to keep their depositors from leaving, they had to pay out dollars. It is simple math. When more money goes out than comes in, you die. They ran out of time. They ran out of cash. Now, $261 million in assets might sound small to you. In the grand scheme of Wall Street, it is a rounding error, but do not dismiss this. In banking, a small crack in the dam is all it takes to flood the valley. The cleanup crew is already sending the bill. The FDIC estimates this failure will cost the insurance fund about $20.7 million. Now, they will tell you this doesn't cost the taxpayer a dime. They say the money comes from fees paid by other banks. Technically, that is true. But don't be naive. Think about how a business works. When their insurance premiums go up, do they just eat the cost? No. They pass it on to the customer. When banks pay more to the FDIC, they charge you more. Higher overdraft fees, lower interest on your savings. In the end, the American consumer pays for every single failure. You are paying for their mistakes. The pieces are moving on the board. First Independence Bank out of Detroit stepped in. They bought the scraps. This is the strong eating the weak. It shows that some banks are still hungry to grow, provided they can buy assets at a discount. But this raises a massive, terrifying question. How many other weak banks are out there right now, teetering on the edge? There is a secret list. The FDIC keeps a confidential record of problem banks. These are institutions at high risk of collapse. You are not allowed to see this list. I am not allowed to see this list. We only find out who is on it when the doors are locked and the lights go out. But I have analyzed the regulatory data, and there is a specific signal that tells us which region is about to get hit next. I'm going to break down that specific danger zone in just a minute. You need to know if your money is parked there. But first, look at the regulators' strategy here. It has changed. They are aggressive now. They aren't waiting for a panic. They aren't waiting for a line of people around the block screaming for their cash. They are moving in like ninjas on a Friday night. They seize the bank, sell the assets, and change the sign out front before business opens on Monday. They do this to keep you calm. They want to maintain the illusion of stability. But to a sharp observer, this aggression proves the system is stressed. This happened in late January. That timing matters. It sets a dark mood for the rest of 2026. Wall Street analysts are now going to tear apart the earnings reports of every regional bank in the country. They are hunting for the same disease that killed Metropolitan. And that disease is usually commercial real estate. This is the toxic asset of 2026, office towers, shopping centers. Metropolitan likely had a book full of these loans. Imagine you lend a guy $10 million to buy an office building. 3 years later, that building is empty and only worth $6 million. The borrower walks away. The bank is left holding a bag of dirt. You are technically insolvent. You just haven't admitted it yet. This fits the big picture perfectly. The Federal Reserve kept interest rates high to fight inflation. This is the casualty count. This is the cost of war. Metropolitan Capital was not a rookie bank. They opened in 2005. They survived the 2008 crash. They survived the housing crisis. They survived the global pandemic. But they could not survive the rates of 2026. That tells you how brutal this environment is. It is a grinder. It wears down even the smartest management teams. When they tried to find investors to save them, nobody picked up the phone. Why would you? Why would an investor buy stock in a struggling bank when they can buy a government bond and get 5% risk-free? The money is gone. We call this a capital strike. And once the capital goes on strike, the bank is dead walking. Without access to new cash, they couldn't absorb the losses. They were dead in the water. So the regulators stepped in. They protected the depositors and buried the bank. They did it quickly. They did it quietly. But make no mistake, the closure of Metropolitan Capital is just the first domino of 2026. It won't be the last. We are now entering the danger zone. Economists call this the lag effect. Think of high interest rates like a slow-acting poison. The Fed feeds the economy the poison. You swallow it. You feel fine for a while. But 18 to 24 months later, the patient drops dead. We are exactly in that window. The poison is working now. The pain is becoming visible to everyone on Main Street. The news trucks will leave Chicago next week. The headlines will fade, but the trend is undeniable. This is the great consolidation. The American banking system is being forced to merge. Main Street is losing its local lenders to the history books. The big banks are eating the small banks. And this creates a terrifying reality. We are moving toward a world where only the absolutely largest banks are safe. If you aren't banking with a giant, you are taking a risk. But there is a specific reason why this is happening now. It isn't random bad luck. It is a systemic disease. I want you to understand this disease because it is likely sitting on the balance sheet of your bank right now. The disease is commercial real estate. For 50 years, lending money for office buildings was boring. It was safe. It was like printing money, but the world broke. The post-pandemic economy destroyed the value of office towers and shopping centers. Look at the major cities. The offices are empty. The lights are off. If the building is empty, the landlord doesn't get rent. If the landlord doesn't get rent, they can't pay the bank. And when they can't pay the bank is left holding a giant concrete box that nobody wants to buy. In some cities, these buildings have lost 40% of their value. That is a catastrophe. For the last 2 years, banks have been hiding this. They play a game called extend and pretend. A borrower says, I can't pay. The bank says, okay, let's just pretend you are current. We will extend the loan for another year. They do this to avoid admitting the loss. They don't want to write it down on their quarterly report. They are kicking the can down the road, but you can only pretend for so long. Eventually, the math wins. The failure of Metropolitan Capital proves that the regulators are done playing games. They are walking into banks, looking at these zombie loans, and forcing the banks to tell the truth. They are forcing them to mark the assets to their real value. And when they do that, the capital is wiped out instantly. The Federal Reserve is trapped. They are stuck between a rock and a hard place. They want to cut rates to save these dying banks, but they can't. Why? Because inflation is still lurking in the shadows. If they cut rates, prices skyrocket. If they keep rates high, banks collapse. So they have chosen the slow bleed. This isn't the panic of 2023 where massive banks failed in 48 hours. This is a slow motion train wreck. The winners, the giants, JP Morgan, Bank of America, they will pick up the pieces for pennies on the dollar. The losers, the small business owners, the people who rely on local banks to keep their payroll running, they are being left out in the cold. When a community bank dies, the local economy dies with it. The handshake deals? Gone. The new owners from New York or Detroit don't care about your grandfather. They don't care about your story. They care about an algorithm, and that algorithm says rejected. This is the hidden contagion. We call it a credit crunch. When banks stop lending, money stops moving. When money stops moving, small businesses can't hire. They can't expand. They fire people. It starts in a boardroom, but it ends with a for lease sign on your main street. Now think about the scale here. Metropolitan Capital had $261 million in assets. That is a drop in the ocean. Do you know how much commercial real estate debt is coming due by 2027? $2 trillion. That is a tsunami. And guess who holds most of that debt? Small, regional banks. Just like Metropolitan, they simply do not have the cash to survive the wave. The data is screaming at us. Delinquency rates on commercial mortgages just hit a 10-year high. That is the smoking gun. This isn't just bad management at a few banks. This is math. Borrowers took out loans at 3%. Now they have to refinance at 8%. The math doesn't work. No amount of financial wizardry can fix that. This creates a deadly cycle. Investors are terrified because they don't know which bank is holding the toxic waste. We only find out the truth on Friday evening when the FDIC locks the doors. This fear drives deposits away. People pull their money out of small banks and run to the giants. We call this deposit flight, and it kills the small banks even faster. It becomes a self-fulfilling prophecy. Smart money moves first. They leave the retail depositors, people like you, holding the bag. Now you might say, but I'm insured up to $250,000. Sure, but what if you run a business? Your payroll account is probably way over that limit. In 2023, the government stepped in to save everyone. But will they do that for every small bank in 2026? That is a massive gamble. Washington does not want to bail out every single failure. It is political suicide, so the official policy remains. You are insured up to the limit. Anything above that, you are on your own. This forces you to become a risk manager. You cannot blindly trust that your bank will open on Monday just because it was open on Friday. You need to do your homework. Look at your bank's loan-to-deposit ratio. Look at their exposure to commercial real estate. If your local bank has 80% of its loans in office buildings, run. That isn't banking, that is gambling, and you are the one putting up the chips. Metropolitan Capital was a warning shot. It tells us the era of easy money is dead. We are entering a period of creative destruction. The weak are being culled from the herd. Economists say this is healthy. They say it cleans out the bad debt. That sounds nice in a textbook. But in the real world, it threatens the plumbing of the entire economy. The Federal Reserve knows this. They are trying to execute a controlled demolition. They want to blow up the zombie banks without bringing down the whole skyscraper. But there is a problem with controlled demolitions. Sometimes the explosives are stronger than you think. And sometimes the building falls the wrong way. We are watching the detonator right now. And the next explosion is going to be bigger than anyone expects. The entire banking system is a high-wire act. The wind is picking up. The wire is shaking. And the failure of Metropolitan Capital proves that the safety net is full of holes. But this isn't just about money. It's about psychology. Confidence is the only currency that matters in banking. If you believe your money is safe, the bank survives. If you panic, the bank dies. It is that simple. Every time you see a headline about a seizure, a little piece of that confidence chips away. It cracks. It crumbles. And when enough people start to doubt the system, that is when the real chaos begins. We call this behavioral contagion. It changes how you act. You save more. You spend less. You hoard cash. You stop investing. And that fear turns a small correction into a full-blown economic recession. Metropolitan Capital gave us a glimpse into the future of 2026. Get used to these announcements. We are going to hear a steady drumbeat of failures as loans mature. This is the maturity wall. Banks kicked the can down the road for years. Now they have run out of road. Here's the problem. It is called the refinancing gap. Let's say you borrowed $10 million for a building. The loan is due today, but the building is only worth $6 million now. The bank says, pay us the $10 million. You say, I can't. So you hand them the keys. The bank takes the loss. And that wealth, it disappears into a black hole. Regulators know this is happening. They are staffing up. They are hiring armies of contractors to manage failed banks. That should tell you everything you need to know. The bank failure business is booming in Washington. The smart money is already circling like vultures. They are waiting to buy these distressed assets for pennies on the dollar. This is where fortunes are made. But for you and me, this is a time for defense. Do not be a hero. Diversify your accounts. Do not keep all your eggs in one basket. If you have more than the insurance limit in a single bank, you are playing Russian roulette with your life savings. The system is designed to protect the system. It is not designed to protect you. But here is the most dangerous part of this story. It isn't the loss of capital. It is the loss of liquidity. When a bank like Metropolitan fails, it stops lending immediately, permanently. It creates a vacuum. It sucks the oxygen out of the room for every small business in town. We are already seeing this. Banks are tightening their standards at the fastest pace since 2008. They want higher credit scores. They want more collateral. They want your firstborn child. This means perfectly healthy businesses are being denied loans. They can't grow. They can't hire. And that is how a financial crisis becomes a painful recession for the working class. The ripple effects are hitting construction, retail, manufacturing. Projects planned for 2026 are being canceled right now because the financing evaporated overnight. This leads to layoffs. This leads to less spending. It is a negative feedback loop. The Federal Reserve is watching this credit crunch with extreme concern. They are terrified. But here's the scary part. They are powerless to stop it. They can't force banks to lend money, and they can't force borrowers to take bad deals. But there is one specific sector that is going to get hit harder than any other. It is the one place where most Americans have their wealth trapped. And if this sector crashes, it takes the whole economy with it. I am going to reveal exactly which market is next on the chopping block. You need to prepare before it is too late. They can print money, but they cannot force a terrified bank manager to lend it. Think of it like pushing on a string. The Fed pushes money into the system, but the string just goes slack. The money sits there. It doesn't move. This is a classic liquidity trap, and we are walking right into it with our eyes wide open. The only way out is painful. We have to purge the bad debt. We have to let the fire burn. That is what happened on that Friday afternoon in Chicago. Metropolitan Capital burned down. It was ugly. It was necessary. But here is the brutal truth. The pain will not be shared equally. The wealthy, they have escape hatches, they have private credit, they have connections, but the small business owner on Main Street, they rely entirely on the local bank. And when that bank fails, they are stranded. This widens the gap. It accelerates the consolidation of power. Decisions about your money move from your local town to a skyscraper in New York. Wall Street does not care about your local bakery. They care about efficiency. They care about quarterly profits. The failure of Metropolitan Capital is a victory for centralization. We are moving toward a world dominated by a few megabanks, and that makes the entire system incredibly fragile. If one of those giants falls, there is no safety net big enough to catch them. That is why keeping small banks alive is actually a matter of national security, but the market forces unleashed by the Federal Reserve are destroying them, systematically, ruthlessly. The regulators will respond the only way they know how. More rules. They will demand banks hold more cash. That sounds good on paper, right? Safer banks? But here is the paradox. If banks have to hold more cash in the vault, they have less money to lend to you. They stopped giving loans for houses. They stopped giving loans for cars. The cure makes the disease worse. We are watching this play out in real time. The regulators were asleep at the wheel while banks loaded up on toxic debt. Now they are waking up in a panic and slamming on the brakes. And when you slam on the brakes at 100 miles per hour, you cause a crash. Metropolitan Capital was just the first fender bender. There is a massive pileup ahead. If you want to see where the real trouble is hiding, stop looking at the stock market. Look at the bond market. The smart money is screaming that danger is ahead. They are pricing in a wave of defaults that will make 2026 historic. They are moving into short-term treasuries. They are moving into gold. They are running away from regional bank stocks and commercial real estate. This is a massive rotation of capital happening under the surface. You won't hear about this on the evening news. It is too technical. It is too boring. But money never lies. And right now, the money is scared. They see the leverage. They see the lack of cash. They see the falling asset prices, and they are voting with their wallets. They are getting out before the next shoe drops. For you, this is a time for extreme caution. Do not chase high returns. The risk of ruin is too high. In this market, the goal is not to make money. The goal is to keep the money you already have. Return of capital is more important than return on capital. Keep your powder dry. Wait for the dust to settle. The opportunity to buy distressed assets will come later. We are not there yet. Why? Because most people are still in denial. They think this is just a blip. They think everything is fine. But I want to show you exactly how deep this denial goes. There is one specific indicator that usually flashes red right before a total collapse, and it just started blinking. They want you to sleep soundly. They say Metropolitan Capital was an isolated event, a one-off. Do not believe them. In the world of finance, there is never just one cockroach in the kitchen. If you see one scurrying across the floor, there are 100 more living in the walls. You just haven't seen them yet. The plumbing of the banking system connects everyone. When one pipe bursts, the pressure hits the whole house. And the speed? That is the new killer. We used to think of a bank run as a line of people in trench coats standing in the rain, pounding on the doors. That is history. That is over. A bank run in 2026 is invisible. It is silent. It happens on a smartphone while you are eating dinner. Millions of clicks, billions of dollars moving in a nanosecond. Metropolitan Capital didn't have a line out the door. It bled to death digitally. It was drained before the regulators even put their coffee down. The regulators are fighting a digital war with analog weapons. They are bringing a knife to a nuclear fight, and they are losing. This leaves you with one option. You have to be your own central bank. You have to be your own risk manager. You cannot rely on a promise. A promise from a banker is worth the paper it is printed on, and right now, that paper is burning. You need assets that don't depend on someone else paying you back. Gold, land. Cash is in a safe at home. If the system goes dark for a week, can you buy food? If the answer is no, you are vulnerable. Metropolitan Capital broke its promise. It closed its doors forever. This is the new reality. The era of cheap money is gone. The era of the small, friendly local bank is ending. We are watching the centralization of America. The big get bigger. The small get eaten. You have a front row seat to the greatest wealth transfer in history. But knowing the system is breaking is only half the battle. You need to know exactly where it breaks next. I mentioned earlier that there is a specific signal that flashes right before a bank fails. I have analyzed the balance sheets of the top 50 regional banks in America, and 3 of them are flashing red right now. One of them might be holding your money. You need to see this list before the news breaks. Click this video right here. I break down the specific banks that are in the danger zone. Click it now, and I will see you there.